America. I'm Hugh Hewitt. Once a month, I talk to Stephen Patterson of Key City Capital. And what I want you to know is that Key City Capital is a sponsor of my show, keycitycapital.com/Hugh. I and the fetching Mrs. Hewitt are investors in a Key City Capital fund, which you cannot get into, but you should know that. And their fund that you might hear talked about today may or may not be open by the time you decide to get your money into Key City Capital or read the prospectus. But before you invest with Key City Capital, read their prospectus and talk to them about it. Good morning, Stephen. You're following John Campbell. And this morning, later in the day, we're going to get out the new home sales. And the rate is supposed to be 675,000 a year. I don't think they're going to make that number because I think housing is still weak and rental is still strong. What do you think?
No, I think that's spot on, and all the data from past months are beginning to show that. You've got 30-year mortgages right now, Hugh, bumping up around 7%. One of the most telling statistics I've seen recently was on Zillow. 3 years ago, you needed to have an income of about $75,000 to buy a median home in the United States. Today, that number is approaching closer to $150,000 to buy a home in the United States. Wages just aren't keeping up with this, and it's keeping people in rental properties much, much longer.
Would you walk through that again, Stephen? Because that's kind of stunning.
Yeah, it was rather remarkable when I saw it, and this was on Zillow is where I found this. So 3 years ago, if a family wanted to buy a home, that they needed to have a $75,000 income and they could enter the housing market. Now, I want you to think about this for a second, Hugh. This is when we were talking about 2.5% and 3% interest rates, right? Well, today that interest rate is more than doubled. Most 30-year mortgages right now are being written around 7%. Home values in this inflationary environment have gone up significantly. And so what's happened is the wages of that family have to grow almost double to meet a median home value because interest has doubled and the value of the home has gone up so substantially. Median home value in the United States right now, $385,000. If you think about a kid coming out of college and he's gotten married and worked for, 3 or 4 years and they've been smart and they've saved their money, tell me how many kids at 28 to 30 years old are going to be able to afford a $385,000 home. They can't.
Not unless they're on two incomes and have no children. Stephen, I'm curious about the rental costs. The Key City Capital, Key City Mortgage, keycitycapital.com, keycitycapital.com/you. What has happened to the average rental in America in the same period of time? Has it doubled?
Yeah, you're seeing rent rates jump significantly over this period of time. And so what's been really instrumental for investors is you're entering into a property. Our model right now is assuming debt. So we're buying stuff between 3.5% and 4.25% interest, right? So we're getting really low fixed interest, no variable interest rates. And then we're watching these rent growths and these property values continually grow. And so it's made for a very interesting on-ramp for investors. And what I like to talk to everybody about is, you need a portion of real estate in your portfolio. We are not a one-stop shop that fixes everything, right? That is not what I'm talking about. But having a real estate position that can take advantage of an economy like this just makes a lot of sense for your listeners.
That's what keycitycapital.com/you does. By the way, how many is interest up? It's got to be an accredited investor. You talk to accredited. Yeah. Is interest up?
Oh yeah, no, we've had we're onboarding as many people as we always have. It's been a great time for us, and one of the things that I'm talking with people that call me is, listen, stock market is hitting at record highs right now. So, if you want to diversify, now's a great time to take some earnings off the table, position them in a real estate investment. You've had a great run up. Let's diversify while the market's high. People invariably make the mistake of trying to diversify when the market's sold off. It's too late. You diversify while the market's up so you can take earnings off the table, not convert losses into a diversification.
A great bit of wisdom there from Stephen Patterson, keycitycapital.com/you for all of your diversification needs. I encourage you, get the prospectus, read it, and be an accredited investor. And call Stephen, right? That's the best thing to do. Call you.
Absolutely. I look forward to talking to a number of listeners over the next few days.
Thank you, Stephen. Always a pleasure. We'll find out whether or not I'm right. I don't think they're going to hit 675,000 home sales on an annual rate. They're supposed to. I don't think that's the case. Not when you're at 7% mortgages. I think people are staying in their rentals because they don't have a choice. And the all cash purchases that John Campbell talked about last segment, I think those are pretty much gone by the board.